As we march through September and head into October, there is a major event taking place that has some economists talking about an impact on consumer spending in the economy for the months and years to come. That, of course, is the restarting of student loan payments here in the United States. Student loans are set to restart after a 3+ year hiatus due to the COVID pandemic. They were paused as many people faced hardship, with many workplaces entering into a lockdown. The pause was there to provide some temporary relief and let money be spent on time-sensitive costs and bills during the pandemic. Well, the pandemic has come and gone, but the US government has delayed restarting those loans. That is until the government spending standoff in Q2 that ultimately led to the Fiscal Responsibility Act being signed. Due to that loss, student loan payments must restart 60 days after June 30th. Additionally, the Biden administration tried to cancel up to $20,000 worth of student loan debt for many student borrowers. Ultimately, his order was struck down by the Supreme Court, which means that loan payments will be restarting in their full amounts. There is a lot of heated political debate about whether we should or should not cancel those student loans. I am not here to debate any of that. Instead, today we are going to focus on what the student loan restart means for the greater economic picture. From a Government Accountability Office report, I found that approximately 42.3 million consumers have federal student loans, and those loans total $1.6 trillion that are expected to be faced with a resumption of payments for the first time since the beginning of the pandemic-related payment moratorium. Unfortunately, the report did not give me the expected cost of those payments, but from another source at Experian, I did find that student loan borrowers will make an average monthly payment of $203 starting this summer toward their student loan balances. Blending the data from those two sources gives us an expected $8.6 billion monthly payment on student loans that is about to resume, or $103 billion on an annual basis. That is a sizable chunk of change that will now be redistributed to debt servicing. So my question then becomes, how will that impact the rest of the economy? Looking at the latest numbers on GDP, we see that the personal consumption expenditures component for 2023 is expected to be about $18.3 trillion. If we assume that all of the money going towards servicing student loan debt would have otherwise been spent on personal consumption, no savings rate whatsoever, then we see that student loan repayments only make up about 0.56% of that amount. According to a report by Moody's Analytics, they estimated about a 0.4 impact, so my rough calculation isn't too bad. On the surface, $100 billion is a lot of money, but is it enough to cause problems for the economy estimated at 26.8 trillion total GDP? Not likely. As I already mentioned, the money will be redistributed from consumer spending, savings, or other debt servicing to debt servicing the student loans. This does not shrink the overall size of the economy. If you found this video to be expanding your knowledge rather than shrinking it, then please give the video a like and consider subscribing for more economics content in the future. In a recent video, I spoke about how consumer spending is a big reason why we have staved off recession. Consumers are buying and continue to buoy the economy through their wallets. The small reduction we'll see from the student debt restart is just not likely to have a major impact. Its share of the total personal consumption expenditure is too small. And by now, Wall Street and Main Street have likely factored in the student debt restart into their forecasts for the remainder of the year and going forward, as this has been signaled. Essentially, it's already priced in. We could even see a small net positive effect in the macroeconomy as that money is being siphoned away from personal consumption spending. We might see inflation continue to ease as some demand pressures loosen as that money is spent towards debt servicing instead. To what extent this might be is uncertain, but certainly it's not going to hurt inflation. While the macroeconomy might not notice the student debt restart, 42 million households or individuals certainly will. In an economic environment that is faced with higher prices and real wages that have not kept up with inflation, that means that the loan restart will continue to stretch people's budgets and wallets. Savings will thin or be drawn down as households need to factor in the additional debt servicing payments. In the medium term, debt delinquencies will need to be kept an eye on. It's worth noting that the Education Department is offering a temporary on-ramp repayment program that does not penalize borrowers for late, missed, or partial payments for 12 months. Borrowers don't have to take any action to qualify for the program, so I'd expect at least a 12-month lag on any larger delinquency issues. I'd expect that student debt delinquencies and credit card delinquencies would rise first as people keep making mortgage or car payments to keep their house and vehicle. But if any of those delinquencies spike too high, then we could see some larger problems in the economy arise in the not so far off future. If you like this video, then consider checking out my video about consumer spending on the screen now. Thanks for watching, and I will see you in the next video.